Hey everybody, welcome to Mortgage Today for Thursday, March 21st, 2024, and oh, what a day it was. UMBS opened the day up 9 basis points this morning. Bonds were stronger in the overnight session, with the Fed follow-through buying overseas and weak manufacturing PMIs in Europe. The Philly Fed Index came in at 3.2 on a negative 2.3 forecast. That's quite a big beat. It was 5.2 previously. Philly Fed prices were 3.7. It was 16.6 previously. Man, somebody needs to double check their math on that. That is incredible. Jobless claims came in at 210,000 on a 215 forecast. It was 212 previously. Continued claims came in at 1.807 million versus 1.803 previously. S&P Services PMI came in at 51.7 on a 52 forecast. It was 52.3 previously. S&P Manufacturing PMI came in at 52.5 on a 51.7 forecast, 52.2 previously. In the economic projections, the Fed raised their estimate of this year's GDP growth from 1.4 to 2%, pushed down their estimate for unemployment from 4.1 to 4, and increased their estimate of core inflation growth from 2.4 to 2.6. During the press conference, Jerome Powell said that the recent disappointing inflation numbers might be due to seasonality. Shall we factor that in? And he also said that the Fed might begin to taper its balance sheet runoff. I think the comments on the tapering of QT were a surprise to the market. Theoretically, this would be a positive for MBS spreads, although the Fed's mortgage-backed security portfolio is way out of the money, and the only runoff will be from people who are moving. When asked about shelter inflation, he mentioned that rents seemed to be cooling off, and he was convinced that overall inflation would be lower. Overall, the stock market liked the decision, and the bond market seemed to take comfort in the fact that quantitative tightening might decrease going forward. Although we still got plenty of Fed issuance because we are in such a budget deficit. The Fed Fund futures didn't make any dramatic changes after yesterday, although the June chances of a rate cut increased about 60% to 75%. Although the June chances of a rate cut increased from about 60% to 75%, while the December's futures remained at 3 cuts. The December's futures are handicapping a bigger chance of 100 basis points than 50 this year. Despite many households locking in lower mortgage rates, household interest expenses are skyrocketing. In 2020 quarter 4, the peak of the In 2020 quarter 4, the peak of the In quarter 4 of 2020, the peak of the dot-com boom, interest expense related to GDP hit an all-time high of 2.2%. In quarter 4 of 2000, which was the peak of the dot-com boom, interest expense as a percentage of GDP hit an all-time high of 2.2%. In 2007, quarter 2, shortly after the onset of the housing bust, interest expense as a percentage of GDP cyclically peaked at 2.04%. As recently as 2022, quarter 1, they were 1.1%, their lowest since 1959 quarter 4. However, in 2023 quarter 4, interest expense as a percentage of GDP was a shocking 2.02 and rising rapidly. This is deeply concerning. Looking solely at the end of the day trading levels in the bond market, we could conclude that we are once again deprived of any meaningful motivation for momentum. That's partially true in the sense that today's events were not top tier. Nonetheless, we can still make a case for some relevance. After all, bonds were definitely stronger ahead of the morning's data. The initial weakness could be coincidental, but But the 9:45 a.m. reaction to the PMI data was fairly clear in terms of volume and volatility. That's interesting. That's interesting considering it was mostly in line with forecasts. Some analysts suggested that the focus was on the confidence metric at a 22-month high in the services sector, and that's a fair take. If we're trying to justify the reaction in the bigger picture, we're waiting for next Friday's PCE data before we really decide something. UMBS closed the day pretty flat, up 2 basis points at 100.77. So at 100.77 is putting us just below this 50-day moving average, but above the convergence of the 100-day moving average and the 25-day moving average, which are kind of working in opposite directions towards each other. Then we got that Fibonacci line that's definitely been a tough one. But we can't control the Fed. We can control our own minds. So definitely check out our video series on the 5th agreement. So the 5 agreements is probably the best book per word, per chapter that you'll ever read. And then you don't have to read it because you just see our video notes at www.wellthatmakesense.com.